Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at a breakdown of performance across the globe and have a look at what has been a very strong patch for global equities. We'll also show that emerging markets now are more of a play on tech than developed markets. And finally, we'll do a review of that MPC decision last week. We can start off with an update on the Strait of Hormuz. The betting market is attaching a 50% chance that traffic through the strait will get back to normal by the end of July. So another 2 months or so to go. But there does appear to have been some progress towards some form of settlement. And as a result of that, we've seen a decline in oil prices. And oil's now come off the boil by about 15% or so over the past month. And as a result of that, gas prices in the US have come down already. And as those gasoline prices have come down, the odds of the Republicans taking the Senate have gone up. They're now slight favorites. The Democrats are favorites to take the House. The Republicans are slight favorites to take the Senate. And it just shows the political constraints that the White House is facing. And as a result of that, they require energy prices to come down at some point, presumably quite soon. And as a result, it's certainly in their interest for the strait to open up fully. So there's a space that we're monitoring. There hasn't been too much change with regards to those probabilities over the past couple of months or so, but it is encouraging that we are starting to see some energy prices come down. And on that note, we're going to have a look at what's happened to global markets over the past few months. It's been a very strong patch for global equities. The 12-month number is a bit distorted by the after effects of Liberation Day in April last year. So those numbers are going to be very strong because the base was very low. I think it's more instructive to have a look at what's happened over the past 6 months, where performance has been very good. Global equities up close to 14% over the past 6 months. And if you look at a range of markets, all the markets that we track, they've been pretty strong over that period. It is interesting to note that the US has been a slight laggard over the past 6 months, up the 11% versus the global number of close to 14%. The key story in equities, though, across the globe has been emerging markets. Absolutely rampant performance. Emerging markets up 30% over the past 6 months, led by Taiwan and South Korea. But nonetheless, it does appear that leadership has shifted across equities from the US towards emerging markets at this point. If you look at bonds, not much of a story there aside from South African fixed income, which has been very strong over the past 6 months again. The rest of it, you're looking at sort of low to mid single digit returns, which is what you would largely expect from fixed income. The dollar again hasn't been much of a story. Returns have been relatively muted over the past year or so. There's been some volatility within that, but you're looking at a dollar which is just marginally weaker over the past year. The rand has been stronger though. So while the dollar has been relatively flat, there have been a handful of emerging markets that have done very well, emerging market currencies that have done very well, the rand amongst them. Gold recently come down a bit over the past 3 months or so, down 14%, but it is still up 38% year on year and still up 7% over the past 6 months. And there, this energy numbers I mentioned earlier, energy recently coming down. So there is a question here to ask, I think. And the question is, how have global equity returns been so strong, even outside of those few EM counters that have done so spectacularly well? Even outside of that, you're still looking at returns which have been pretty good. And there's a couple of primary reasons for this. First of which is earnings. If you look at the US as an example, there have been widespread beats in the last reporting season. 85% of S&P 500 companies that have reported so far have beaten on the bottom line. And if you look at earnings expectations, they're pretty good. In the US, earnings are expected to be up 23% this calendar year relative to last year. And that would raise the base quite materially. And even more impressively, earnings at the moment next year are expected to be up 15% off that very high base. And it's a very similar set of numbers for the globe. There again are some emerging markets where the numbers are simply spectacular. But even outside of that, we're looking at an environment of pretty buoyant earnings growth, which has been very helpful for markets. As part of that, just talking about those plays in emerging markets which have been so strong, the net result of the very strong rally that we've seen in tech plays in South Korea and Taiwan is that tech IT now accounts for 41% of the EM basket, which is actually above that of the global average of 32%. And that means that emerging markets at this point are actually more of a tech play than developed markets. And it is quite interesting. If you take a step back, you're looking at this environment of these handful of counters that have done so very well, and that's pushed up emerging markets. But in addition to that, very strong earnings growth across the globe. And it does lead one questioning how that's possible when GDP growth hasn't been anywhere near as spectacular. For example, if you look at the US, the revised GDP number came out last week, and US growth in Q1 was revised down from 2% to 1.6%. And that was below the consensus forecast. Now, if you look going forward, the consensus forecast is that GDP growth is going to be about 2% over the coming few quarters. So if GDP growth is going to be around 2% or so, and inflation, well, it's difficult to forecast, but at the moment, let's say that inflation is going to be around 4%. That gets to nominal GDP growth of around 6%. Yet we saw that those consensus forecasts for earnings next year are 15%. So it is the case that earnings growth has outpaced GDP growth and is expected to outpace GDP growth going forward. And that is anomalous. If you look at global GDP growth, median GDP growth across the globe is now sitting at 2.3%. That's down from 2.5% the middle of last year. And that shows that global growth is slowing. And if you look in the US, you look at the savings rate, savings as a percentage of disposable income, that number has come down a lot. And normally, if that number is coming down, you would expect that people are out there spending more, and that would be correlated with faster GDP growth. But we're in an environment of weaker GDP growth, sort of 1.5% or so, with savings rates that are pretty low as well. And that's pretty concerning stuff. So you would think in that environment that there would be some concern around the prospect for earnings over the long term. But that's not the case. If you look at what's currently priced into the US and a few other key markets, what's currently priced in is for dividend and earnings growth to be strong forever. What's currently priced in, reversing out a dividend discount model, is that earnings growth over the very long run in the US will be about 7% per annum. So you're looking at 15% next year, and thereafter still quite high numbers that will be higher than nominal GDP growth. And that's a little bit concerning. And we've got this disconnect at the moment where clearly earnings have been very buoyant, and that's provided a lot of support for the market. And we don't want to be underweight in that environment. And that's actually why we went back to neutral. But at the same time, the market is extrapolating this out for a very long period, suggesting that earnings growth is going to be above GDP growth for a very long time. And it can't be above GDP growth forever. And as a result, there is this disconnect that makes us a bit uncomfortable. So we don't want to be overweight either. We don't want to be underweight because of the very strong earnings numbers at the moment. We don't want to be overweight because the market is starting to price in some very good earnings growth over the long run. And as a result, we're sitting neutral. In addition to what we've seen in equity markets, it is important to note that 10-year bond yields have been shifting up. They've been shifting up because of higher inflation expectations, and they've been shifting up because of greater competition for capital, emanating from greater investment, for example, all the investment that we've seen in data centers. So the net result of that is that the cost of borrowing for governments has been going up. And in time, that should act as a headwind for equities. But in addition, it should also make the debt problems that a few developed markets are facing, like the US, a bit worse. And so this is just something we need to keep in the back of our minds as well. This is something we're going to have to monitor fairly closely. In time, this could become a problem. The market doesn't seem to be concerned just yet, but it may well be an issue in time. And finally, in South Africa, last week, the MPC increased the repo rate in South Africa to 7%, as was widely expected. The market is expecting another 2 hikes over the coming 12 months, which, to be fair, is pretty consistent with the messaging from the SARB. So where does that leave us? Well, at the moment, real rates in South Africa, the difference between interest rates and inflation, are very high. Outside of recent history, they're close to the highest that we've seen in 20 years. And that will act as a handbrake on consumption, as they're designed to do. And the net result of that is that the growth outlook in SA at the moment is in question. Now, we will revise our outlook for SA in the next month or so, but we just need a bit more clarity on when that strait is likely to open, because it's absolutely critical for the outlook for South Africa. Should oil prices remain elevated for the next 3 to 4 months, we're looking at, say, potentially up to 3 hikes from the SARB. Whereas should we see a quick and continuing reversal of oil prices, i.e. if oil prices continue to come down, that picture could shift quite materially. So the next month or so is going to be quite important in setting the outlook over the next 12 months for South Africa, and we'll provide an update accordingly. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.